broader markets holding out, trading about flat for the mid caps, but up 0.3% as far as the small caps go. But let's bring in our first guest for the day. Gujarat Heavy Chemicals posted a quarter that saw quite a weak quarter. In fact, this time saw a 27% fall as far as profits go and an 11% decline for revenues. We have the management of the company joining in now. GHCL Managing Director R.S. Jalan joining in with the highlights of the quarter gone by. Mr. Jalan, thanks very much for joining in. You know, a bit of a disappointment in a few of the headline numbers. So if you talk about the full year revenue for FY18, it declined to 1,046. That's from 1,227 crore last time around. Just help us understand what were the factors that really played into this time.
Hi, good morning. If you look at our performance in a progressive quarter over quarter, in quarter 2, we have achieved a PAT of around 53 crore. Against that 53 crore, the second quarter, means I am talking Q3 FY18, we had around 73 crore. And in this quarter, we had a PAT of around 82 crore. Now, if you look at the quarter by quarter, there is a significant improvement which we have been able to achieve. Now, as compared to Q4, which you just indicated, yes, our revenue had dropped from 826 crore to 733 crore. In spite of that, our EBITDA remains at the same level of 185 crore versus 185 crore. And our margin has improved from 22% to 25%. Now, this has been a good performance, and if I give you a number on overall basis of the last 1 year of FY17 versus FY18, in spite of our guidance of the textile industry is passing through a headwind, we have been able to close our year with a very stellar performance of 367 crore against last year of a PAT of around 387 crore. Now, this performance we have been able to achieve because of a very good performance from our inorganic chemical, where our revenue has significantly improved, our margin has improved, and overall, in spite of textile business or textile industry's headwind, we have been able to close a very good performance of this year. Our cash generation, if you look at last 1 year, we have almost made a cash profit around 464 crore. Against that, we have allocation also we have done very nicely. We have rewarded the shareholders by giving them 104 crore by way of a dividend as well as by buyback of the shares. We also invested around 282 crore into the capex to make sure that the growth journey of the company remains. And we also reduce our debt by 117 crore, which brings us our debt equity ratio to the level of 0.79, which is a very healthy debt equity ratio for a company. Overall, I would say that the performance has been good for us, and overall, I would say that in spite of this textile industry's headwind, we have been able to achieve a very significant or a very successful year.
Fair point you're making there, Mr. Jalan. In fact, you know, your inorganic segment actually managed to really keep things afloat while the textile segment came under pressure. So let's talk about the textile segment then. Obviously, a lot of pain in this space overall across the industry. GST has been a big contributor to that. What is the outlook now for the textile segment? Do you expect that on the back of this weak quarter that you've had, in fact, a few weak quarters as far as textiles go, we will see a significant uptick going ahead?
Yeah, first let me tell you why the headwind has been seen into the textile business, so that we can look at in a perspective that how the things have been changing now. See, last year the overall textile industry has passed through various difficulties. One was the weak dollar. That has really reduced the margin, and the second was your government incentive has also been reduced, and overall in the US market, which is a very significant market for the home textile business, has been passing through a structural changes from brick and mortar to it is going towards the digital platform. All these things are really made an impact into the business of the textile in India. Now, going forward, my belief is that things are improving. Like if you look at the rupee has weakened in last few days, that will really help this industry. Overall, in our business, I would say that definitely the positive signs are being seen. One, we have launched one innovative product which is a very environment friendly product, and which we have launched in the end of March into the US market, and we are seeing a good response on that. So definitely I see a better year into the textile. However, the headwind of the industry will continue for a few more quarters.
Right, a few more quarters, expect textiles to remain under pressure, but with, of course, the weaker rupee, things should start looking good for the textile space. What did well then this quarter was, of course, the inorganic segment. If you could give us a sense of what really played into the strong performance here and what the outlook is for the space.
See, first of all, in the chemical business, we had our performance on the utilization of the efficiency had been the global benchmark. We have achieved more than 97% of the efficiency. The second was definitely our focus on the cost. That has also helped us. And the third is overall the demand growth into the chemical business has also been very good during this year. Almost around 11% growth against the overall average of last 10 years of around 5%. So demand growth has also helped to us to achieve this number.
All right, and are you expecting this?
Going forward?
Right. Go ahead, sir. Right. Here, are you expecting this kind of demand to remain elevated for this space?
Yes, I would say that the demand should be healthy going forward as well.
Would you be able to keep, your performance at these elevated levels? 11%, is that a realistic target if you talk about fiscal 19 quarters as well?
I don't think 11% should be the benchmark. It could be a little lower number, but overall the demand growth will be robust, and that will help this industry to continue with the stellar performance.
All right, fair enough. In fact, when I was going through the presentation, something interesting was that the decline in your revenue, it's mentioned, was primarily due to this reorganization that you've done of the customer mix in the home textile space. How are you changing your mix? If you could give us a sense of how things will look going ahead.
See, like I said, in the textile business, the structural changes is happening into the US market, and thus structural changes are making some of the retailers unviable as well. And so therefore, that's the one reason that we need to reorganize our retailers. Second is our focus is now more on bringing the innovation into the business, because the innovation is the only thing which can help to go into the new customers, and also to make our ultimate customers excited about the product which we make. So we have launched, like I said, one product we have launched recently, which is environment friendly, or the sustainability platform, which has got a good response. Second, we have also innovated one more product. So all these innovations is definitely going to make a different kind of a customer mix for us, and that will help us to improve our performance.
Right, and Mr. Jalan, just a short while ago, you also mentioned that you've done some significant debt reduction in the year gone by as well. You've reduced debt by 117 crore. Your debt to equity ratio stands at 0.79. How has this improved your cash flows then, and what is the outlook on the debt front going ahead?
See, as we have given the guidance in the past as well, that we as an organization will always be very prudent on our debt exposure, and we will always try to reduce our debt. If you look at the 18-19, again our target will be that we reduce our debt in the same level of around 100 crores. So the cash generation of 400 and 500 crores cash generation, out of that will reward to the shareholders. We will also make sure that the amount goes allocated to the capital or for the capex, and also the reduction of the debts. So we will try to maintain our exposure to the debt as low as possible without compromising on our growth.
All right, fair enough. We'll leave it at that. Thank you so much. That's Mr. R.S. Jalan of GHCL joining in with a fine print into the quarter gone by. Optimistic about seeing a recovery as far as the textile space goes. And of course, inorganic has seen a strong quarter already. But let's also put the focus now on Sterlite Tech. The company saw strong fourth quarter this time, a profit growth of 77%, and also reporting a revenue